Good morning, everyone. This is Julie Stewart. It's just after 11 o'clock, so I think we'll go ahead and jump right in. Thank you for joining us today to learn about multi-year guaranteed annuities and why they are the perfect alternative to a bank CD. I'm Julie Stewart, the Annuity Director here at the Milner Group, and the Milner Group is a full-service broker general agency providing access to fully underwritten life, long-term care, disability, and retirement planning solutions through the use of annuities. We do offer a strategic partnership and access to all the lines of insurance, including access direct to our in-house case managers, product specialists, commission, and licensing teams. The goal being to streamline your business and make it easy for you to develop your practice and attain your goals. So please feel free to reach out at any time if there are other things that you're working on or if you want to learn a little bit more about how we can best support your business. So jumping right in. So jumping right in this morning, you're likely familiar with a certificate of deposit. And let me just see, for some reason my screen is not moving. There we go. So you're likely familiar with certificates of deposit, or otherwise known as CDs. These are easy to understand savings vehicles that protect a client's principal while providing a modest but guaranteed interest rate. So a bank CD is a conservative account. It typically offers a better interest rate than a bank savings account. The interest rate is applied annually, and at the end of the term, it can be renewed. So it's pretty simple. So for instance, they can purchase a 1-year CD, a 2-year CD, a 5-year CD. Now, CDs are not tax deferred, so every year your client will actually have to pay tax on the interest earned. CDs often also apply penalties for any type of early withdrawal. So we've got two things working against the CD right now. They're not tax deferred, and if the client needs to get access to the money, they're typically going to be penalized for that. Now, multi-year guaranteed annuities, which we also just called fixed guaranteed annuities, are the insurance industry's equivalent to the bank CD. So it's a no-frills product designed to accumulate interest without any risk. Now, interest rates are typically 4 to 6 times that of what a bank CD can guarantee. And because the interest rate of the annuity is a guaranteed rate, you can actually calculate the value it will have at the end and show that to your clients as what they can anticipate 100% from a guaranteed standpoint. Now, it may appear from the slides that these products are very similar, but there are a few very important distinctions and the reasons why the multi-year guaranteed annuity may be a much better option for your client. So this chart is kind of helping us compare and contrast the differences. Now, the MYGA has the same features as the CD, but with extra benefits. So they both offer safety of principal. They are fixed conservative savings vehicles. Now, institutional backing. Banks are insured by the FDIC, typically up to about $250,000. The multi-year guaranteed annuities are backed by the State Guarantee Fund, but an important piece of information for you to understand and something that you can explain to your clients too. From a reserving standpoint, banks are only required to keep a very small percentage of their overall deposits in reserve. And that reserve is meant for emergency situations. But insurance companies are required by law to keep no less than 100% of their deposits in reserve. As a result, the failure rate is significantly lower for insurance companies than it is for banks. So to kind of break that down a little bit further, insurance companies save dollar for dollar. Every dollar that a client invests, they put in a holding account. So if anything were to happen, they're 100% protected. The money is there and it is guaranteed. Important distinction. Now, from a liquidity standpoint, most CDs have early withdrawal penalties. In fact, I'm not even really aware of any CDs, although there may be some that allow access without penalty, but for the most part, the goal of the CD is to put the money in there and don't touch it while you gain that interest rate. With the MYGA, your client actually has usually 2 options. They have interest-only withdrawals that they have access to, and then some even allow 10% penalty-free per year. So the MYGA is offering tax deferral and access to the money penalty-free, which is really seen as a positive in favor of your client. We have already talked about the tax-deferred growth. So the lifetime income, MYGAs can be annuitized or turned into a stream of income, typically at any point during the surrender. CDs cannot be turned into a stream of income. So again, this is just another opportunity for your client to know that if circumstances change in their life, the MYGA really gives them a lot of options. They have access to the money, and in fact, they can turn the entire account into a lifetime stream of income. And then Social Security advantages. Bank CDs don't offer any Social Security advantages, but the multi-year guaranteed annuity, in fact, all annuities, will help by means of reducing the taxable income. Clients can transfer amounts from qualified accounts into annuities, keeping that out of their taxable income, allow it to continue to be tax deferred. So they are tax favored vehicles, is just a way to sum that up. And then protection from costs and delays associated with probate. Multi-year guaranteed annuities can avoid probate as long as a beneficiary is listed. It's a very important distinction. So when the client passes away, the account value that passes to the heirs can completely bypass probate as long as a beneficiary, a natural person, is listed. Now, if they happen to name their estate as the beneficiary, it will then go through probate and it will come out the other end less than what it started at. So the statistics shown here are from bankrate.com, and they're basically just comparing the interest rates of several products against Annuity Rate Watch, which is a service for comparing annuity rates. So we're looking at the average 5-year CD rate is about 0.87%, and the average 5-year MYGA is about 1.8. The graph is really just showing the average and best MYGA rate for each year length, and the year length is horizontal across the bottom. Now, as you can see, annuities offer a significantly higher amount of interest than CDs. This difference is compounded even further once the benefits of tax deferral are taken into account. But please note, here at the Milner Group, we represent over 50 carriers, and we provide annuities with even higher rates of interest than the national average. So it's important to know that while the 1.8 is an average, we're often able to put your clients in a much better position. So things to note, it's important to be aware of certain features within the annuity contract. There typically is a 30-day window at the end of the term in which the funds can be withdrawn or removed without penalty. So that means they can take the value and walk away, or they can roll it to a new annuity. If no action is taken, most carriers will just automatically renew for another term. That automatic renewal to another term typically only happens one time, and then the account can become fully liquid. But it's important to understand that the clients need to be on the lookout for their annual renewal statement with their action items of what can be done. And typically they have a 30-day window. Now, it's also important to note that if your client is expecting to need access to money within, the first couple years, or needs to take money prior to age 59 and a half, a CD is likely a better option. And that's because there is the IRS imposed 10% tax penalty that is applied if funds are withdrawn before the age of 59 and a half. So again, for short-term planners, a MYGA may not be the best option. So it's important to ask that question, when do you anticipate needing access to the funds? And, sometimes even if you can't sell the annuity, you can direct your client to what might be a better option. And in that, you're establishing trust, credibility, and building a rapport with your client. It's also important to note that commissions do vary based on age, state, and product. Commissions do reduce over the age of 75, typically by 50%. Again, the length of term also determines, a shorter term annuity is not going to pay as high of a commission as a longer term annuity. So just important to understand how that varies. Now, American Equity has a MYGA called the Guaranteed Choice, and it really is one of the most competitive on the market in terms of the interest rates that they're offering as well as commission. So you'll see here, these are the current rates for American Equity's Guaranteed Choice. The 5 years currently at 2.7. Really the sweet spot right now for them is on the 7-year, which is at 3.15%. So what that means is that this annuity guarantees that every year for 7 years, your client will make 3.15%. That's pretty astounding, you know, when compared to the national bank CD rates. So that, in a nutshell, is really the differences between the CDs and the MYGAs. If you do have any questions or if there's any cases that you're working on, please feel free to reach out directly. I'm happy to answer any questions or point you to some resources. And in fact, if you do have any commission questions, Mandy Beagle's information is listed here for you. She does handle all of the annuity commissions for the Milner Group. So again, with that, thank you so much for your time. We appreciate the opportunity to do business, and we hope you enjoy your weekend.